Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. This show gets you actionable insight on everything investment and otherwise related when it comes to your money. And today I'd like to talk to you about a very interesting report that's released on an ongoing basis. It's called Netra, and it's released by DSP. I'm speaking today with Sahil Kapoor, who's the head of products and market strategist at DSP Mutual Fund. Sahil, thanks so much for taking the time. I make it a point to read this report on an ongoing basis, but let's not get into too many technical details. Let's try and keep things as easy to understand as possible for my viewer. And let me start by asking what I think a lot of people are asking. I've asked this question a lot this week, which is that while you have the benchmark Nifty 50 at very close to all-time highs, you still have a lot of portfolios that have not done particularly well. And of course, this is because of the texture of those portfolios. They are small cap oriented, and the last 1 year has not been great. But what are the details that you've picked up about the concentration of the kind of run that we've had over the last 1 year?
Sure. So one thing is clear that there is a wild gulf between how mid and small cap and how large caps are priced. I think there is a large valuation differential, and it has played out over the last 1 year. And even after, let's say, sort of a consolidation of the last 12 months, this split or this divergence hasn't really improved a lot. So when you look at, let's say, a small cap or a mid cap stock go from stock number 101 to 500, you'll find that on an average, the median multiple for this universe, it's upwards of 40 times, which is a very steep multiple. And when you look at, let's say, the ROE cohort, stock number 101 to 500, the ROEs are in the vicinity of about 14.5%. And when you look at earnings growth over the last, let's say, 6 quarters or so, earnings growth has now slipped to closer to 10 to 12% for this universe. Most recent numbers are sub 10% when you adjust for extraordinary items. I think that is the problem. So the universe trades at a very steep multiple, but it is unable to generate sufficient earnings growth to justify that multiple. So my sense is there is some amount of derating which is happening, but the derating process has been slow, and only because of the last, let's say, 2 weeks or 3 weeks of some price decline has some derating occurred, but I think that is not enough. On the large cap space, I think the multiples were slightly less steep. So if you look at Nifty 50, which trades at about 22 times trailing multiple, which by no means is cheap, it is still fairly highly valued or richly valued. You can use any word that you want to, but Nifty comes at about 15 or 16% ROE multiple, and earnings are also growing sub 10%. So the steepness of the multiple is lower. So I think that is what the market is adjusting right now. Not ready to overpay for lower earnings growth.
Okay. There are 1 or 2 metrics that stand out, right? One of them is the fact that the weightage of the Nifty 50 in terms of market capitalization as a percentage of overall market capitalization is at historic lows. And even the top 10 stocks, that weightage as compared to the overall market capitalization is at historic lows. So it kind of bears into what you're saying. Of course, the market itself has gotten broader and deeper, but at the same time, the valuation picture is what it stands at. So the question that I have for you, therefore, is unless you have a big drawdown, which we haven't seen, we've seen sideways movement, and so time correction, you're not going to see a change in this dynamic. And earnings, while there are certain green shoots, it's more on the profit and the margin front, right? Revenue growth is not taking place. Are there any reasons that your house believes that things could change for the better in the rest of the year and heading into FY27?
So my sense is that, there could be some changes for the better. Let's say we move from 10% earnings growth to 12%, but the problem is it's not enough. And when it comes to the large cap play that you spoke about, that they are like, so when you look at the top 10 stocks, they are hovering at about 20% of the overall market cap, which is one of the lowest that we've seen on record. And so one very important point, look at the margins. Currently, corporate India margins are close to their lifetime high, maybe give or take a % or so. And then you ask a question, what will take profits higher? Okay, how do profits go up? So apart from, let's say, efficiency gains, which will we talk about later, but profit margins or higher sales growth. So you sell what you have more, or you sell it at a higher price. These are the only two levers. Your profit margins are already at a lifetime high. So there is hardly any room to go up. And why this point is very crucial, take any country in the world, the highest profit margins or PAT margin in the world right now is in US at about 10.9% or so. India is very close, maybe a few basis points lower. So our profit margins are already at an extremity globally. I don't know how they will move higher. I don't foresee that. Then the only lever left is higher sales growth. Sales growth is struggling at a mid single digit or a high single digit. You can take a pick. And if you split it up, look at domestic oriented businesses, look at exports. Domestic oriented businesses, the local nominal GDP is 10% or lower, and therefore sales growth cannot exceed that number by a very wide margin. Exports growth is maybe 5-6%, very anemic. If you add back inflation of 4% or so, again, you get a number below 10%. So it's very, very difficult for earnings to go back to what the market needs. It needs 20% earnings growth. That is what it is pricing stocks for. So I think that is the disconnect today.
Yeah, and it's not going to come about anytime soon, at least the way things are going, right? Because that nominal GDP point that you've made, ultimately, while on the one hand you do celebrate inflation cooling off, the flip side of that is that nominal GDP is at 8.8% or maybe even lower, which is a problem, right? So, but having said that, how does, in your opinion, the strategy need to unfold right now? Let's face it, a lot of retail investors did pile up on focused small cap funds. They went a little too broad and they depended on only that. And of course, it's done incredibly well over a 5-year period. But if I look at this month, Sahil, and if I look at last month, your flexi cap funds have gotten inflows of 8,000 crore plus and 9,000 crore in October. And that's positive, right? Would you agree?
Yeah, I think, see, the idea is that flows always follow returns. Wherever there will be returns, flows will come. And that's the unfortunate reality. It's also true that flows cannot create returns. So if you keep putting money in a segment, it will not automatically start generating returns. So I think it's a problem of what comes first. It's a chronological order, and that's what we have to see. My sense is that you can put any amount of money in any asset unless the valuations are good enough. I think decent returns will not be generated. So we have to be very careful in picking and choosing the universe today. When you look at the top 500 stocks today, you will find that almost 20% or there are about 100 stocks which trade with a multiple which is lower than 20 times. That's it. So you're going to be hard pressed to find value across the board in India. In fact, one of the large private banks, which is very cheap today, even if you were to take that and do a DCF and do any valuation metric, you still have to pencil in 2.5 time price to book value just to generate 12 to 13% return. And I'm talking about the cheapest stock available in India today. So it's not easy.
It's not easy. So having said that, what is the messaging that is going out from your fund house, right? Because ultimately, the investor has gone through a pretty rough 1 year. And of course, a lot of people have had the patience, they've learned from past mistakes, and they've continued their SIPs, etc., and keep deploying, right? But they need to hear something from you as well. So what is the messaging that you are putting out with regard to benchmarking expectations, and also at a time when certain commodities are doing incredibly well? Something like a silver is at $62 per troy ounce, per ounce, and you have gold at very near all-time high. So certain performances have gotten skewed significantly. I'm talking about multi-asset funds and a lot of money flowing into that as well.
Absolutely. So we did come out with multi-asset funds about 2.5 years ago. And we thought that that was the best time to deploy because there were a lot of opportunities other than equity. Second thing is, what should be the messaging, you asked me. First, that investors should tone down their return expectation. Do not make the return expectation looking at the past 5 years. It's an aberration. If you look at the last 25 years, Nifty has delivered around 12 to 13% return, a CAGR of 12 to 13% return. Last 5 years, many portfolios have delivered 20, 25, or even 30% return. So this excess return is an exception. It's not going to come again and again. So you need to tone down your expectation. Also, this 12, 13% CAGR sits at a starting valuation where Nifty was at 15, 15 or 16 times trailing earnings, not at 22 times, right? So we need to tone down our return expectation. Second, mix assets. I think there are a lot of other assets which from time to time give you opportunities. For example, at this point in time, India GSEC is beginning to become attractive, where yields have come up slightly. Inflation is very low, government borrowing is also very low. So probably adding a bit of a duration could be a very good play, adding bonds to your portfolio. And as you said, gold and silver has done remarkably well. I'm not very sure whether they are at the right price to start adding them. But from a longer term perspective, they do make sense, particularly gold. And the third and the fourth asset, which is very important and often missed, is the global exposure. And I think that has been missing from a lot of portfolios because Indian investors have focused a lot on the domestic market. So adding a little bit of global exposure, not from a US indices point of view, but a truly global exposure could be a very useful aspect for investors.
Yeah, absolutely. All right. I do want to ask you about something that you put out on social media. I found that interesting. It's an interesting corollary that you've drawn. You said that silver is the equivalent of a small cap fund. Why do you say that?
Yeah. I think it's a more volatile cousin in the precious metal space. If you look at the last 50 years data, gold and silver has more or less performed similarly. Their CAGR returns are very similar at around 10, 11%. But silver's standard deviation, or the way that it moves, is twice that of gold, right? So it delivers similar returns, but is much more volatile. So you have to be very careful in allocating large sums to that commodity.
Yeah, it's a fair point. Sahil, absolute pleasure as always speaking with you. Thanks so much for taking the time.
Thank you for your time. Thanks.